Don't fear the inflation reaper. This is a fantastic article from seekingalpha.com. I was reading this morning doing my morning reading, and I want to share it with you because I absolutely 100% unequivocally agree. And that doesn't mean you have to. It just means you need to hear the opposite side of the coin or the equation, which says, oh my goodness, inflation is coming. I just don't believe it. I don't mean it's, look, man, I have no clue. No clue. No one else does. I just look at Japan as our model, and I truly believe that's where we're going. I don't mean it's going to be as bad, but I think it's more likely of a Japan light model than hyperinflationary of the 70s. All right, so this is a Dateline February 10th, 2020, and that's today. That's yesterday. The cash flow capitalist. The summary. Let's actually not going to go to the summary. Let's just read the whole. We're going to read this because it's a long article, but it's fantastic. Home prices are soaring, and the cost of lumbers are shooting higher as builders race to put up more houses across the country. The price of new and used cars have risen substantially as vehicle production dropped during the pandemic. A friend tells me that firearms and ammunition are impossible to buy right now. And today he could probably sell the firearm he purchased last year for 4 or 5 times what he paid for it. Anecdote after anecdote presents itself to suggest that inflation is coming to roar back. Roar! The backdrop of this inflationary setup has been the astonishing growth of the money in circulation during the COVID-19. During the commie virus. The money supply in the U.S. has increased by over 25% in the last 12 months alone. The money supply in the U.S. has increased by over 25% in the last 12 months. Thank goodness we had a conservative president. Crazy. Surely COVID-19 was the final straw to break the back of disinflation and spark a new secular uptrend with inflation, right? No! And what follows, we'll tackle the inflation reaper one step at a time. First, it'll be necessary to bust the ostensibly reasonable yet factually inaccurate belief that consumer price inflation automatically follows the supply of money. Consumer price inflation, we're going to bust that bubble, automatically increases with the increase in money supply. Second, we'll go through the top 3 segments of the CPI, Consumer Price Index, by weighting and show why none of them are likely to spawn a sustained inflationary uptrend. What we find time and again is that secular inflation is caused by either sustained demand that rises faster than supply, artificial bottlenecks in supply. Artificial bottlenecks in supply, that would be government heavy-handed regulation, as I talk about socialism. Admittedly, COVID-19 did cause some temporary bottlenecks, but those bottlenecks are quickly reversing and in some cases have already reverted to normalcy. And government stimulus did create some temporary additional aggregate demand, but businesses know that it's temporary and for the most part they won't adjust prices because of it. This guy makes such a good point. Well, there's that guy. Ooh, we're all going to die. All right, busting money supply to inflation myths. Yes, trillions of dollars were pumped in the economy over the last year, but that doesn't mean that trillions of dollars were actually spent. I could not agree with that more. They pumped in trillions of dollars. Was trillions of dollars spent on products? We know, for instance, that in the spring months, when the money supply first began to rise, the savings rate spiked to 30%. And the velocity of money collapsed. Remember, the velocity is what the turnover of the money. I spend $1, you spend $1, you spend $1, you spend $1. That's the velocity. I save $1 or pay off debt. That is not velocity. And you can see the velocity of money collapsing while the money supply was increasing. All right. So isn't that interesting? So here's right here. The velocity of money collapsing. The money supply is increasing, and there's a personal savings rate. The velocity of money collapsed. Yes, it's come back a little bit. No, it ain't much, man. Studies have been done on short-term UBI. 2 problems with these experiments is they weren't universal, and 2, they were temporary. While an actual universal basic income would be universal and would not be temporary. The temporary nature of these basic income experiences is what makes them relevant. See, when people get their regular checks during the experiment, they don't behave as if the checks will continue forever because they knew the experiment was temporary and the flow of funds would stop eventually. So what did they do with the money? Mostly they paid down debt and saved it. It's what most people do with unexpected small windfalls. They don't alter their lifestyle or spending habits. They just do what they're already doing and were already wanting to do. In surveys, most people say they would like to save more and pay down debt if their budget would allow. So what happened when the federal government sent almost everyone in the nation a check for $1,200 last year? A Federal Reserve Bank of New York survey from June 2020 found that over 2/3 were spent on savings or debt pay down. Right here, 36.4% was saved, 34.5% was used to pay down debt. So right here, another 3.2% was donated. So that's 70% was spent on donations, paying down debt, and savings. Notice that a mere 7.7% of the stimulus money was spent on non-essential items, discretionary. Most of the money that was spent on essential items like groceries. Folks in lower income households were more likely to pay down debt with the stimulus money. Higher income folks put the money in savings, which meant depositing to the brokerage or speculating in the stock market. The Federal Reserve asked respondents how they would spend the money if they received another check, and here's what they said. 45 to savings, 31% to pay down debt, and 24% to consume, most likely groceries again. When asked how they would use more stimulus money, they said they even use less of the check for personal spending. Now that euphoria of day trading has taken off among so many who don't normally have any interest in investing, I doubt that even 20% of the next stimmy check would be used for spending. After all, you never know. It'll be the last day of the stimulus money, at least until the next recession. But there's another fundamental more reason that consumer inflation is not likely to take off anytime soon. That can be seen by examining the top three components of the CPI, the Consumer Price Index: housing, transportation, and food and beverages. Together, those three things make up 72.5% of CPI. Food and housing is 42%. Food and beverages is 15% roughly. Transportation is another 15%. Medical care is about 9%. Isn't that interesting? Housing, soft demand where it counts. We've heard it again and again that prices of construction are flying through the roof. And they're soaring prices of homes across the country. 7.9% is what it grew last year. Therefore, inflation, right? Wrong! Wrong! Remember that guy, John McLaughlin? At least it's proven wrong as far as consumer price inflation is concerned. It will likely to continue to remain at the level of producer and asset prices rather than consumer prices. See, according to official statistics, home prices are asset prices, not consumer prices. The CPI does not take into account home prices per se, but they take into account what's called owner's equivalent rent. This is so big, man. I had a guy on my YouTube channel say, "No inflation. Have you seen the price of price of houses?" That's like, and my argument against that, frankly, is okay, but I'm not buying a house. Well, why does that matter? I'm not buying one. I mean, literally, if you're buying a house, you have higher inflation, that's for sure. But actually, do you? We're going to show you don't, is what you think. All right? We're going to show you why you don't. It's funny. So anyway, the CPI does not look at the value of the home as part of the Consumer Price Index. They look at what the owner's equivalent rent would be, almost like the imputed income that I talk about all the time when you have a debt paid off, your mortgage paid off. OER attempts to measure the rent that would be charged if the property was rented as opposed to being owned. Instead of looking at the market value of the home, it looks at the ongoing expenses, such as the mortgage payment. The ongoing expenses, such as the mortgage payment, the insurance, taxes, and utilities. OER has not risen nearly as fast as home prices. It rose about 3% last year. From 2014 to 2020, it rose about 3%. In fact, since the outbreak of COVID-19 has moderated noticeably, it only grew 2.2% in 2020, despite the 8% increase in national home prices. I tell you, man, I had forgotten about this. So when I was debating, and I say debating this guy, when I challenge this guy, I say, okay, well, I'm not buying a house. Why does the inflation of home prices concern me? Because I'm not buying. I'm already in a house. Most people aren't buying houses. Most people are where they're at. But I've forgotten about the fact that the value of the home doesn't matter. It matters what it costs to live in the home. All right, so if we go to this guy, so the The OER, again, what's the O stand for? The owner's equivalent rent. What does it cost to live in the home? It was only 2.2%. Why? Well, for one, mortgage interest rates fell significantly. All else being equal, lower mortgage rates equal lower monthly payments, which equal lower costs to live in the home. Of course, lower mortgage rates were offset by rising prices, but they offset each other. I'm getting 2.5% on 30 years now versus that inherently the price of the home is going to increase by 50 or 100,000 bucks. At the same time, lots and lots of homeowners refinanced their mortgages in 2020, so they're not moving, i.e. they're not getting out of the houses, which are increasing in value, so the inflation of home prices didn't affect them at all, but they're lowering their payments and reducing the OER. When you refinance, you lowered your mortgage payments and thus your OER without affecting the cost basis of their home. What about rental vacancy rates? When the vacancy rate is low, we should normally expect to see a faster increase in rents. But since 2008, vacancy rates in rental property have been declining. That's crazy. Since 2008, vacancy rates in rental properties has been declining. There are two primary reasons for that. Eviction moratoriums and government stimulus. This, I'm telling you, man, the eviction moratorium thing, I think is huge. I don't know what to, I mean, many landlords are not collecting full rents from their tenants, and yet they can't evict them either. When those end, it would be natural to see vacancy rates rise. And when vacancy rates rise, what happens to rents? They go down because there's more of a supply of housing. And the government stimulus, either in form of direct checks or enhanced unemployment that some renters have relied on for rent payments, is temporary. Even if another stimulus check is forthcoming, the government stimulus is artificial and temporary. It is inorganic to underlying economic conditions. It does not reflect a long-term rise in demand that would spur an equivalent rise in rent rates. I cannot agree with that more. So basically what happens when you get rid of the moratoriums and you got all these people getting evicted, if this happens, who knows? Who knows? I mean, inherently, you're going to have this huge supply of new renters on the market, of new housing on the market because they're evicting all these people. So a supply of housing, right? And you're still, all these other people like, well, where do I go now? I don't know, but we got this new supply here, this massive amount of new supply with the same, what's that going to do to prices? It's going to drop them, man. I mean, inherently, it's going to drop them. Now, you say, well, it's not quite as a huge supply of pens and stuff like that because you can't. There are things called substitution effect and all this, but obviously these people got to rent someplace, but they're going to rent in a cheaper place, man. So this huge supply of housing, you're still going to have the same demand because these people got to live someplace. What are these people going to do? They're going to go downstream. So it's going to increase the supply of housing, and it's going to make it go downstream for new renters to pay less. It's going to make the prices reduce. I'm telling you right now. In fact, renters were worse for wear in 2020. A Harvard study noted that 54% of renters were unemployed at some point during the COVID-19 crisis, compared to an official unemployment rate of 15%. That's nuts, man. 54% of renters were unemployed at some point. As pointed out in the Yardi Matrix report, multifamily landlords granted significant rent concessions through 2020 and are only beginning to crawl out of the hole in 2021. The largest rent concessions were in high-cost coastal markets where rent had previously been highest in recent years due to constraints in the housing supply. We want affordable housing, but we're not going to let anyone build. Speaking of housing constraints in the housing supply, there are lots and lots of artificial bottlenecks when it comes to housing. Zoning regulations. City planners in some part of the country seem to believe that their job is to restrict housing development as much as possible. If a new mid-rise apartment building casts a shadow in the late afternoon on a corner of a playground, it is deemed unacceptable and denied. This has the effect of restricting the supply of new housing in that area and thereby raising housing costs for its residents. Living in a liberal world must be nice, man. It must be nice. That said, COVID-19 accelerated a trend that has been in place for at least a decade, and that trend is a migration from expensive coastal cities to sunbelts like Texas and Florida. In these states, local housing authorities are much less strict. Build, baby, build! Yeah. Houston has no zoning, none, and guess what? Housing is cheaper there on a population-adjusted basis. Who'd have thunk it? Man, I read an article back freaking when I was in college back in 1993 or something like that about Houston, no zoning laws and how cheap it was. And you could do whatever you want. It's fantastic. I will never live in Houston, but I loved it. In my hometown of College Station, Texas, more and more single-family, multifamily housing continues to pop up, and rents have been flat for 3 years in spite of rapid population growth. Again, who'd have thunk it? Much the same can be said for countless cities and towns across the Sun Belt. Is the weather as nice as California? Nope. Pretty as Washington State? Nope. Exciting as New York City? Nope. But it's cheaper and more business-friendly, hence a migration of all kinds of people to these places. What does this have to do with housing inflation? Well, think about it. If more people are moving into states with artificial bottlenecks on the supply of housing, then housing inflation rises. But if more people are moving into states with fewer artificial bottlenecks, government regulation, then builders can build enough housing to meet growing demand. Inflation does not rear its head. But in the midst of the commie virus, are builders building? Yes! Housing starts are now higher than any point since 2006. Hence, the temporary prices of lumber and builders get over the hump of sudden demand brought by a sudden drop in mortgage rates. But let's take a look at the two charts below. One shows housing starts since 2000. The next shows annual population growth. So we see housing starts, the biggest increase since 2006. Well, it only makes sense because we had such a drop-off. Population growth in the U.S. declining like crazy. So Bill Gates loves that. He wants more population growth to decline. If you know what I'm saying, Bill Gates, yes, he wants you to live. Note these, let's see. One thing immediately jumps out. Since the Great Recession, housing starts and population have been trending in opposite directions. Here's housing starts going up, population going down. That is not inflationary. There's strong evidence that COVID-19 will cause as I talked about in the global economic ice age that's coming, there's strong evidence that COVID-19 will cause a drop in birth rate as recessions and financial uncertainty tend to spur couples off from having kids. I completely agree. Net migration has also tapered off, and Sniffy Joe does not seem to be making immigration a priority anytime soon. So home builders are currently building homes at a faster rate than any time in the past decade, and yet population growth is slowing. Not a recipe for inflation. Energy. Huge oil reserves. Rising prices of energy are reflected all across the CPI because all products and services use some form of energy, be it gasoline, natural gas, or electricity. Thus, when energy costs go up, it tends to cause prices to increase. In the 1970s, the category of CPI most heavily affected by changes in energy prices is transportation. The second largest segment of CPI is that is 15% of the CPI basket. For transportation, one of the largest costs naturally is fuel. And most vehicles run on some form of oil. Thus, it's useful to gauge the supply-demand balance of oil to determine whether we might be on the verge of a sustained rise in commodity price. Certainly, looking at the rebound of oil since the peak of COVID, the oil price is surging. Yeah, but there's a big difference between oil price recovery on the back of a return to offices and traveling and a sustained upward price in oil. In fact, we can see the following chart. Every time an uptrend in the price of oil has gotten away, something has come along to derail it. The most recent event to come along to derail the price of oil was fracking, 100%, which opened up vast swaths of previously untapped and untappable resource, or oil reserve. Look at this. This is the oil reserves. Proved oil reserves. Look at that. Almost tripled. Proved oil reserves, about what's that, 28 billion, and now it's at 68 billion in 10 years. Proved has more than doubled in the last decade, which a huge increase in supply. What does that mean for inflation? Huge increase in supply, non-inflationary. But the U.S. is not alone in the expansion of proved oil reserves. Here we go. Brazil approved oil reserves right here, 163%. U.S. is 114%. China is 68%. Well, Russia is in a world of hurt, so they don't know. Saudi Arabia, again, Saudi Arabia is tiny. But if we had got some smart guy in Venezuela, Canada, what the world's massive hell, at Mexico. What the world's massive proven oil reserves tell me is that there's a ceiling to the price of oil. Could not agree more. At any time, the U.S. OPEC and other oil producers can flip the switch and ramp production. Yep. Then there's a limit. Thus, there's a limit to the price of oil growth, as such as a limited upward pressure oil will put on the CPI. What about the cost of electricity? Well, I've already talked about that. This hasn't gone up hardly at all. It just hasn't for kilowatt hours. So here we got average retail price of electricity going back to 2012. I mean, that's 9.5 cents to 10. It just hasn't gone up that much. And what we can say, because solar, it's not because of solar, it's because of fracking and natural gas, man. All the ways to it. According to EIA data, average U.S. residential prices rose 1.4% a year from the last decade. Across all end users, residential, commercial, industrial, transportation, electricity prices rose less than 1%. More of this rapid cheapening of electricity from renewable sources stand to slow this price even further. I'm going to do another video on the insanity of wind. It's horrible. The cost of generating electricity via photovoltaic has dropped like a rock in future years. He talks a little bit about cost of some guy, a futurist. I don't care, because at the end of the day, it's the natural gas, which is allowing that to happen. What you see above is called deflation. The costs are dropping like a brick in water. I do apologize for being snarky, but it seems that some cognitive dissonance in many people's mind when it comes to technological advancement and future inflation. We're pretty darn close to hitting zero interest rates, which are the psychological effect of appearing that we've reached the end of the road. We've hit peak disinflation and falling interest rates. People think now the process will begin to reverse. But at the same time, many of those who hold that view also nod their heads at the idea that the future will be abundant. Innovation will drive down prices. Technology will continue to make most things like cars and energy and consumer products cheaper. Yep. Now, with the falling cost of electricity generate the lower utility bills for consumers? Well, maybe not, but it certainly won't be huge upward trend in electricity. When it comes to food and beverages, what we experienced last year is an anomaly. Inflation is caused by either sustained demand that rises faster than supply can keep up, or artificial bottlenecks, and that's what we had. We had a supply chain breakdown. But those days are the fastest period of food and beverage inflation was between March and June of 2020. This 4-month period alone experienced a 3% increase. Supply lines broke down. Grocery stores experienced a sudden massive burst of demand. But the entire supply chain has quickly re-emerged because we are capitalists. We are not relying on Sniffy Joe or Donald Trump to tell us what to do. In short, my argument is that money supply growth most likely won't result in large or sustained bout of consumer inflation. And aside from money supply growth, the fundamentals of housing, transportation, food, and beverages don't support the inflation thesis. The country has been in a long disinflationary trend since Volcker raised interest rates in the 1980s and Reagan broke the labor union back in the 1980s. Since then, interest rates and inflation have been dropping and debt levels have been soaring. If you ask me, the bull case for high-income, long-term bond of alternatives like net lease REIT still holds. I don't know what that is. Anyway, that's great stuff, man. It's one of the best articles I'll put in the show notes. Highly suggest you think that through. I could not agree more. Good stuff across the board. And, of course, we still have Japan model. Money supply in Japan is through the roof. No inflation. All right, we'll see you.